What is up, guys, and welcome to Lecture 2 of the TCT mentorship, where I'm going to be teaching you everything that you need to know to understand ranges. And it's absolutely crucial that you guys understand ranges because the TCT schematics are built around range deviations and ranges, okay? So understanding how to draw your ranges properly and how to look at deviations is absolutely crucial and will make the TCT trading and the TCT concepts later on in the mentorship way easier to trade. Okay, so what exactly is a range? Well, a range is when price is simply moving sideways. Okay, you guys already know about markets trending up and down and the shifts in trend after lecture 1, but markets can also move horizontally. And this is when we identify our ranges, and people also like to call it consolidation phases. Okay? So, why do we even range? I want you guys to look at the markets as if it's a normal human being for a moment, okay? And when prices are pumping, compare it to a human sprinting. Eventually, it will get tired, quote unquote tired, and needs to refuel, gather more energy before going at it again. Same with the markets. After an aggressive expansion towards the upside or downside, price likes to form a range before having either continuation or a reversal. As you can see, after every aggressive expansion, we had a range. Expansion, range. Expansion, range. Expansion, range. This entire span of 2 years, after every aggressive expansion, you form a range. The actual theory behind it is that when prices are pumping or dumping, the market is very one-sided. So when we're pumping, everyone wants to buy, buy, and buy. However, for every buy order, there needs to be someone selling to them. And eventually that ratio of buyers and sellers will get so one-sided, so out of hand, making price have to consolidate because there are not enough sellers for the buyers to continue to pump. And in that consolidation, the ratio will be mostly rebalanced before having either that continuation or that reversal. And that's already a little introduction to Wyckoff regarding the purpose of your range. So, how do we pull our ranges? Okay, how do we pull our ranges? When price is trending up and we're making higher lows and higher highs, we pull our range from top to bottom, and when we have a move back up, touching the equilibrium of the range, that's when we have a confirmed range. So we're trending up, we use our range to our Fibonacci from top to bottom, and when we have a move back up, touching the equilibrium of the range, that is when we have a confirmed range. When we're trending down, we pull our range from bottom to top, and when we have a move back down, touching the equilibrium of the range, that's when our range is confirmed. Okay? So your range low is already confirmed the moment we have a move back up touching the equilibrium, the 0.5 fib of the high to the low. But that doesn't make it your market structure low, like we discussed in lecture 1. It's only your market structure low when we have a move towards that market structure high and we touch it. So your range low is already confirmed prior to a market structure low being confirmed. Same over here. Normally, when we're looking at structure, this market structure high is only confirmed when we touch the low. But your range high is already confirmed when we touch the equilibrium of the range. So a range is only valid on a certain time frame if the 6 candle rule applies in this market structure drawing, okay? So you want to have 2 candles up on that time frame, 2 candles down, and 2 candles back up again. Whenever you have that, that's when that range is valid on that specific time frame, okay? Same when we're trending down. You want to have the 2 candle rule here, the 2 candle rule there, and then the 2 candle rule coming back down again. That's when your range is confirmed on that time frame, okay? On that specific time frame. Now, applying this knowledge to the Bitcoin chart, we already know how to draw our structure, right? So we had this low right here, and then we have a high, and then we have a higher low for a higher high. If we zoom in right here, we pull our range. We're in an uptrend, so we pull our range from top to bottom right here. Let's make it range. We pull our range from top to bottom, range high, range low, and the moment we have a move back up to the equilibrium of the range, that is when our range is confirmed. Now, this range immediately ended up being a breakout and just continuing its market structure. But that's not always the case, because if we extend it, yet again, we have a higher low for a higher high right here. And then in an uptrend, we pull a range from top to bottom. This being your range high, this being your range low, and move back up to the equilibrium of the range, confirming the range. From here, we just had range deviations. Now, we're going to get into deviations later on in this lecture, but for now, just know that this is a range deviation. But even if you did not use it as a range deviation, we can just continue structure, higher low, higher high, and pull it from the uptrend. Okay? Now, range high, range low, move back up to the equilibrium, confirming this macro range. Right here, we broke structure back to bearish, right? So we could expect that lower high for the lower low like we were talking about. But now our structure is pointing down, and in a downtrend, we pull our range from bottom to top, okay? Range low, range high, move back towards the equilibrium, confirming the range, okay? From there, we continued our downtrend with a low and then a high. And when we're downtrending, we pull our range again from bottom to top, and a move back down towards the equilibrium of the range confirms the range, okay? From there, we had that massive move up. Let's keep that here. From there, we had that massive move up, pointing up, back in that upward structure environment. So when we're in an uptrend, we pull our range from top to bottom. There you go. And they move back up towards the equilibrium of the range, confirms your range. And from there, we had a range deviation. Okay. Again, that will be explained later in this lecture. And then we broke structure back to bearish. So right when we broke structure back to bearish, that brings us in that downtrend environment, making us pull our range from bottom to top, okay? So, range low, range high, move back down towards the equilibrium of the range, confirming the range. From there, we continued that structure drawing, lower high and lower low. Again, a range low, range high, range low, range high, move back down towards the equilibrium of the range, confirming the range. So this is a crucial example where I'm applying that 6-candle rule, okay? I'm applying the 6-candle rule where you have the 2 candles coming down, you have the 2 candles coming up, and you have the 2 candles coming down again. So while putting in this high, that's already confirming your range. This is not the first range high. This is the first range high, because that's when we had to move up and down, already touching the equilibrium of the range, making this a range deviation. So this is a range deviation high, but when drawing your structure, it's your market structure high, okay? But this was your initial range high, because from here, we already had to move up and down, applying that 6-candle rule in the 3-day time frame, making this already a confirmed range, and this was just a range deviation, okay? So we continue drawing. This wasn't a range on the 3-day because there's no valid structure. And then from here, we were already in a downtrend. Again, pull our range from bottom to top. But now, look closely again, guys. Look closely. This is how your range started. Range low, range high, move back down towards the equilibrium. From there, we had one deviation, and we can extend it towards that deviation high. We had another deviation, and then we just deviated the high over and over again, each deviation being slighter and less aggressive, and then we dumped down, confirming this now as our range. But on these 2 points right here, that's where your range started, but it ended up expanding. And this is going to be more clear later on in the lecture after understanding deviations. But it's crucial that you guys understand that the range originally on the 3-day time frame started here. You always have to watch, when do I have that 6 candle rule applying with our range low, our range high, and they move back down towards the equilibrium. Okay? And then that's how your range originally started. So this is how the range started here, and it just expanded into a bigger one, deviating the high over and over again before having a rotation back down towards the range low. Okay? I always want you guys to check, I'm telling you this now, I always want you guys to check what the highest time frame is that your range is valid. Okay? Because this is going to be crucial for deviations. So always apply that 6 candle rule where you want to have 2 candles coming down, 2 candles coming up, and then 2 candles coming down again, touching the equilibrium, not touching the low of not the market share low, no, touching the equilibrium, confirming already the range, because understanding what the highest time frame is that your range is valid is going to be crucial for the deviations. But for now, we can see, the examples I have on the chart in the introduction of this video are basically all these ranges. You see, we just drew them, and they're literally all these ranges right there. So let's get our charts cleaned up again. There we go. Let's talk about deviations. What is a deviation? A deviation is when price exceeds your range high or low, but it does not break it. And when this happens, we can expect a reversal towards the range low or close to the range low if we deviate the high, for example. And if you deviate the low of the range, we can expect a move back up towards the range high or just close to the range high, okay? Definitely in the upper section of your range. How do we know if something is a deviation or if something is a break of structure? And that should already be the question that came to your mind while listening to me talking about deviations. Because how do we know that this is not just a higher low for a higher high and we can expect the trend to continue, right? Or a deviation and we can expect a reversal. So, the easiest deviations will always be the wicks, since a wick is not even a break of structure and we can expect a reversal. We were talking in lecture 1 about, hey, if we wick our market structure high and we break that structure from the low up, we can expect a rotation back down towards your market structure low. Well, now put in a ranging environment. We have an uptrend, we have our range high, we have our range low that got confirmed right here on this equilibrium touch, and we wick the high. So now we can call the range high, and if we break structure, we can have a rotation back down towards the range low. Very easy. Wicks are always the easiest deviations because it's not even a break of structure in the first place. Okay? However, I have also taught you guys about good break of structures and bad break of structures, right? Where that good break of structure, it had that good distance away from your market structure high and a minimum of 1 candle close above it before retracing. That was that good break of structure. Well, the bad break of structure was whenever you see something like this, where we break our range low, but the second candle immediately comes and closes back inside. And it's very simple. A bad break of structure falls into the category of deviations. So whenever you break your range low and you immediately come back inside, making it a bad break of structure, a bad range low break, that falls in the category of a deviation. It's that simple, guys. We have a wick, which is obviously the easiest form of a deviation because it was never a break of structure in the first place. So you should have never even looked for a higher low for a higher high unless you broke structure from the top down. Also discussed in lecture 1 when we can expect a continuation even though we wicked it. I think it was scenario 2 if I'm not mistaken. But secondly, we also have a candle close deviation, and that's simply just when we have a bad break of structure. However, I have something else for you guys. And that is called the deviation limit. What is the deviation limit? In short, the DL. The DL is simply a limitation of how far price can deviate based on the size of a range set at 30%. Preferably, when you want to call a range break a deviation, you do not want your price closing above your DL. So what can you see right here? In black, you can see our market structure, okay, where we have our high, we have our low, and we got that move back up towards the equilibrium, confirming the range. Our range high and our range low is 100% of our range size, obviously because it's the high to the low. Our deviation limit is set at 30% of our range size. So what you can do when I'm double clicking on my FIB retracement, you can do a 1.3 and a negative 0.3, which will give you 30% above your range high and 30% above your range low, making this your deviation limit, okay? So when price is breaking your range high, but it doesn't close above your deviation limit, it still falls obviously in the category of a deviation. And when you're breaking the range low, but you're not closing below your deviation limit, it still falls in the category of a deviation. Now, a few rules regarding this DL tool, right? It's very nice to have somewhat of a threshold for deviations, and that's what I'm giving you right here, okay? And that 30% is just like it, when you look at it with your own eyeballs, and when you become more experienced, you'll kind of see that it also looks clean when it doesn't deviate too big, because when it deviates too big, it just looks like structure more, right? It looks more like structure. But a few rules regarding your DL is that whenever you have a deviation that didn't close above that DL and you come back inside your range, you extend your range high to the deviation high, okay? And then your DL will increase as well because this stays a 30% of your total range, but your total range increases in size because you're moving your range high to your deviation high. So whenever you have a deviation that didn't close above your deviation limit and you come back inside your range, you need to extend it, okay? Extend it to that deviation high, and from there use those limit lines again, okay? Now, another thing is that when I have, for example, a very good looking demand zone, okay, a very good looking demand zone, which is something we will be talking about in lecture 3 or 4. No, I think it's 3. But when I have a very good looking demand zone overlapping my deviation limit, I'll just picture this deviation limit being below the demand zone, because we could close in the demand zone and still get that bounce because it's a good looking place to look for a long, right? So even though it will close maybe a tiny bit below that deviation limit line, it's still okay. Okay, so whenever you have your DL lines overlapping with demand or supply below and above your range, just picture your DL line and your DL limit above that supply zone or below that demand zone. Okay, just a few rules regarding that deviation limit. Now, the lower the time frame my range is, I can keep this on my chart for you guys, by the way, right here while I talk. The lower the time frame that my range is, the more strict I become with my deviations, okay? When I'm trading a higher time frame setup, price likes to act heavier. And what I mean with like heavier is that whenever you're trading a high time frame setup, they oftentimes have bigger deviations, okay? They have bigger deviations that just take more time to manipulate more people compared to low time frame setups. So when I'm trading high time frame setups, you can kind of use this DL. You can always use the DL too, but you can expect some deeper deviations, some deviations that take more time on the higher time frame, because the higher time frame just moves slower, okay? And they want to manipulate more people, and therefore more time spent above your range high. It will trick people into thinking that it's actually a range break while it's not, okay? Now, on the lower time frame, on the other hand, when I'm on the 5-minute and I'm on the 10-minute time frame, I want my deviations to be quick, okay? I want a wick or just a bad break of structure, but immediately, deviating that high and immediately coming back inside. I want everything to be quicker, okay? I want everything to be quicker and more strict, because the lower time frames are already more risky, so I want everything to look better. So quicker deviations, nice wicks, and nice, immediate deviations coming out of the range, and then boom, getting acceptance immediately back inside of the range, okay? And coming back, if you guys remember, I told you guys always look for the highest time frame that your range is valid on. And coming back to that is, if you check your ranges, okay, your range could be valid on the 30-minute, applying the 6-candle rule, but it could also be valid on the 4-hour, applying the 6-candle rule. And it may seem like a break of structure when you're deviating your high, okay? You can always use your DL2, which will save you probably 99% of the time. But when you're on the lower time frame, this may seem like a break of structure where you have all these candle closes above, multiple candle closes above. It's not a bad break on the 30-minute. It's the break. It looks like a break on the 30. But your range is also valid on the 4-hour. And on the 4-hour, that 30-minute break could literally just look like 2 wicks on the 4-hour time frame, therefore making it a wick deviation, and a very nice deviation, right? So always check the highest time frame that your range is valid on, because it may seem like a break on the 30, but if the range is also valid on the 4-hour, it could literally just be either a bad break on the 4 or a wick on the 4. So that's something to look out for, okay? But you can always check using your DL2. Now, let's talk about different ranges, guys. Let's bring back our overlapping market structure, okay? Let's bring back the overlapping market structure. Let me make sure everything is going okay. We're all good to go. Perfect. Hope you guys are following me. Hope you guys are understanding me. I think I'm making sense. But in general, guys, this is just repetition, right? You listen to what I'm telling you. You listen to the rules. You apply the rules. And you just play in the chart, okay? Especially in the end of this mentorship, we'll have multiple videos where I go over my trades in a systematic approach, step by step of, high time frame to low time frame to finding that micro entry, okay? But different range pools. You guys know about overlapping market structure now. So if you understand overlapping market structure, that means we'll also have different range pools. So let's say we are trending up on the higher time frame, and we have a high, and we have a higher low, and we have a higher high. We know now that we can even keep it till here, that we're trending up on the higher time frame, so our range is put from top to bottom. Range high right here, range low right here, and this is where that range is confirmed, okay? But this may look like one move down on the 4-hour, But maybe on the 2 hour or on the 1, we have some sort of a downtrend here, right? Like this. Let's make it red. So maybe on the 4 hour, your price action looks like this, and then when you go in on the 1 hour, you actually see some sort of a downtrend to get from point A to point B, like discussed in lecture 1. I'm going to get rid of this equilibrium, guys, otherwise it's going to get too messy, but we know that on the black dot, that's where our black market structure range got confirmed. But locally here on the lower time frame, we're in a downtrend. That's the only way to get from point A to point B. And in a downtrend, we pull our range from bottom to top, right? And you'll actually see some sort of a ranges right here. Same right here. That's why I drew it the way I drew it, guys. You know, with the extra pools inside. And right here. Right? So we may actually have some sort of a range right here coming down. But you know there are multiple types of structure, guys, because we can even go on the lower time frame, the blue market structure, and we could actually, for example, in this uptrend, we could have some sort of, or even here, we can have some sort of extra structure, right? Don't want to make it too messy, but we can have some sort of extra structure, that blue structure drawing, where right here in this retrace, we're in the downtrend, and we can see a range on the lower time frame. And then we break back to bullish, and we can see a range on the, again, lower time frame, but from top to bottom. So we can have multiple ranges depending on what type of market structure that we're drawing. But what you're already seeing here is not only just multiple ranges based on market structure, we also see ranges within ranges, because this is now a massive range, right? This is a massive range. And inside of this range, we have, the moment the range got confirmed right here, we have another range, right? And that can continue itself for a long time. And ranges within ranges are so common. It literally almost all of the time you have a range within the range. Literally almost all of the time. So let's say we have a range right here, okay? Should draw that, move back up. There you go. And we have our range high and we have our range low. Range high, range low, confirmed. I want you guys to understand that price, whenever we are ranging, we can have many internal rotations inside of the range without taking an extreme point, like this. Many, okay? Now, I don't want you guys to get confused trying to draw market structure when we're ranging, because we're just ranging. We're not trending, so we're not drawing our structure. Whenever we're ranging, we can have many rotations from high to low inside of the range, okay? Where this upper section is what we call the premium section of the range. So above the 0.5 to our range high is what we call premium pricing. And then from our equilibrium towards the range low, that's what we call discount pricing, okay? So we can have many rotations from premium back to discount, from premium back to discount. And I don't want you guys to get trapped into trying to draw structure to also, look at ranges when we're just moving horizontally. So whenever we're ranging, always the most important market structure pool to watch is just your most recent expansion. So right here, to get from this premium pricing towards this discount pricing, price is moving down. So we'll have some sort of downtrend here, okay? We'll have some sort of downtrend. And then to move up back up again, we have some sort of uptrend, okay? Until we range again, and then we can have some sort of downtrend again. Just like that. Let's make this red. So red is representing our internal price action, and meaning price action within our market structure high and our range low. Okay? So whenever we have internal price action and internal range rotations, the most important structure to watch for is just the most recent expansion. So when price is here, okay, we just had that move down, so this structure pool is the most important to watch, okay? And then from there, we can see we were having lower highs and lower lows, and this became a range. And then we can trade this range and potentially rotate it back up towards the premium section of the range. And from there, we're trending up, so we pull our range from top to bottom. Right here, it comes back to the equilibrium, confirming it, and maybe we'll look for some sort of short, rotating it back down towards the range low. And then from there, we have some sort of downward structure coming into that lower area, and then we pull our range from bottom to top, and then we can look for some sort of range to rotate it back up again. So ranges can have many rotations, and don't get trapped into trying to draw your market structure from the low up, because that's useless because we are going horizontally, okay? But we can have rotations within the range, but when we have rotations within the range, just look at the structure from the most recent expansion. So right here, looking at the structure down to form your range, and then right here, we're going back up, so looking at your structure from the low up to confirm the range, etc. Okay? Let's look at it from a live example on Solana right here. So I'm gonna delete this right here. Go into replay mode for you guys. There we go. So basically, we're trending up massively. Okay, we have our high, we have our low. I'm applying the 6 candle rule, guys. I'm applying the 6 candle rule. We have our high, we have our low, we have our move back up. Okay. Let's pull that Fibonacci tool, and we can clearly see that we have our range high, we have our range low. Let's make this black. And we have our move back up towards the equilibrium of the range, confirming this as our 3-day range. Massive range, okay? Just a massive range. Now, I'm going to delete these lines for now. So it becomes more clear, but you know that we have this massive range going on, okay? And right here, it got confirmed. Now, if we go on the lower time frame, okay, we may actually see something more, like we just discussed. Because to get from our range high to our range low, we need to have some sort of downward structure. Otherwise, how do we go from point A to point B? Where we need to go down, so probably have some sort of downward structure. So applying my market structure on the 18-hour, we can see a high, a low, a lower high, a lower low, a lower high, and a lower low. Let's make that red. Let's represent it in red. So right here, we're trending down. What do we do when we're trending down, guys? I'm going to get rid of this equilibrium, otherwise it will get too messy. But what do we do when we're trending down? We pull our range from bottom to top. And now, let's already apply that DL2. Okay, let's already apply that DL2. So, what can we see right here? We have our range low. Let's make it red. We have our range low. We have our range high. We come back down to the equilibrium of the range. Okay, valid range. We're on the 18-hour, trending down. Trending down, pull your range from bottom to top. And right here, it already touched the equilibrium. And you can clearly see that this move up, right? This move up was simply a deviation. Why? It was a wick. It was a wick, okay? But we also did not close above our DL2, making this a range deviation, and what followed was a move and a full rotation back down lower. Now, our second market structure pool looked like this. We're trending down. Trending down, we pull our range from bottom to top. This being your bottom, this being your top. And right here, you come back down to the range. Confirming this as a new range. So we can see that, yes, we have a massive range going on right now, but right here, we already had local ranges. Okay, we already had local ranges. Now, right here, we confirmed that macro range. Okay, right there, we confirmed that macro range. So now I know, okay, let's just watch the rotations, right? We have our range high, we have our range low. We know that these were ranges. Let's put it as a range. Otherwise, it would become too messy. Now, See, we can put that 0.5 on. Right here, we have a range, but from the low, we are trending up, okay? Because we're just going to watch the most recent expansions. We're going to watch our rotation from the low to the high, potentially towards the low again. So we have a low. Right here, the range got confirmed. So the moment it got confirmed right here, we can draw this structure like this. Get rid of the EQ again. We're in an uptrend locally from our first ranged rotation back up. Pull our range from top to bottom right here. Hat your range high. Hat your range low. Had that move back up, touching the equilibrium of the range. And then from there, I think this was a deviation. Maybe you just missed it. No, there you go. It was a range deviation, and you moved up higher. Okay? So you can see that we have ranges now within ranges, because the black dots represent one massive range, and the red dot represents the lower time frame ranges. Okay, the ranges within ranges. And coming back to that drawing of mine, we know now that we can have many range rotations. Okay, it could do this for way longer before having a breakout or a, grab that extreme point, grab that main range high point or the main range low point. So right here, when we have to draw the rotation, we can see the rotation down, we can see the rotation up. So when we're moving up, we're in an uptrend. So I'm drawing my structure from top down. Right here, we're moving back down again. Okay, we're moving back down. So from this point to this point, okay, we were in some sort of a downtrend. So let's zoom in. Okay, let's zoom in right here, see what we can find. What I immediately already see, okay, is I see some nice looking support. Some good looking demand on the left here. Guys, how I pull this demand is going to be explained in the next lecture, okay? But this is good looking demand. This is good looking demand right here. And I can see our most recent rotation is from this top to this bottom. So I know I'm in a bigger range. Like, the context is that we're in a bigger range. I'm just watching my local rotations right now, and this is the most recent rotation from this high. We had a high, we had a low, we had a lower high for a lower low, lower high, lower low, lower high, lower low. I'm just watching my structure, guys, just watching the structure. Okay, we came into an area of support. We're in a downtrend. In a downtrend, we pull our range from bottom to top. Okay, let's use that DL2. There we go. We can see this was our initial range low. That's our initial range high. We came back to the equilibrium right there. Okay, I want to make these dots smaller, by the way. We came back to the equilibrium of the range, confirming the range low, and from there we had that first deviation tapping into demand. Okay, first deviation right here, tapping into demand. So let's get rid of this structure drawing. And guys, is this a deviation? Is this a deviation from a break perspective? Yes, we have a wick, and then we have one candle close below it, and then we have a candle close back inside. So even just look at it from a bad break of structure perspective, this was a very bad break of structure, making a deviation. But we also had our DL limit not being exceeded. Double the confirmation, right? Definitely a deviation when that happens. Plus, we also had support. So even if our DL limit was above our demand zone, I would pull it below that demand zone, okay? Locally speaking. So I wouldn't put it in this case all the way down here, because when that happens, I will still call it a range break. But if the DL limit was right here, I'll just put it a bit below it, okay? Just a bit below it. Give it some more margin, because we have good looking demand on the left, which will be clear why this is good looking demand in the next lecture. So we know we have a range, and we have deviation 1, or we have range low, and we have a deviation here. Now, I'm already going to give you guys a local sneak peek into TCT concepts, but this means it could be a potential Model 1 accumulation or a Model 2 accumulation. Okay? Not going to explain why yet, but that will all be clear. Now, guys, the same way how we can have this range inside of this massive range. More locally speaking, we could have ranges inside of this 4-hour range, right? Because I'm on the 4-hour now. So if I go on, let's say the 45-minute, for example, okay, let's say if I go on the 45-minute, we clearly know this was a deviation. So what do? I extend it towards that new deviation low. There we go. Put these dots into place. This is where it got confirmed initially. There we go. Now, we can look exactly the same way how we found this 4-hour massive range. We can look for more ranges inside, because the moment we confirm our range, okay, we had that move down, we had that move up, and we had that move back down again, confirming the range right here. Now, we can just look for those range rotations I was talking about earlier. The same way. It's the exact same way. Because from here, we deviated the low, and then we had to move back up again, and then we had to move back down. So now I'm watching those local rotations for potential market structure pools for potential ranges. So I think if I'll keep this here, it'll become a bit more easy. This is our 4-hour range. Our red dots represent our 4-hour range, with our range low, our range high, and a deviation here. You know, that was in between our range low and that DL limit. Now, let's just watch the most recent expansions. We have a low, we have a high, higher low, higher high. Was this a good trading range, guys? Well, we had our range high, we had our range low, we came back to the equilibrium, but we immediately broke out. See the candle close above it? So this range is not more a range, it's more market structure trending up. Okay, more market structure trending up. So we can continue drawing it, a higher low, higher high, boom, came back down, came back up. Oh, wait again. Range, uptrend, pull our range from high to low. Let's get rid of this equilibrium, otherwise it's going messy. Range high, range low, equilibrium touch, confirmed range. Hey, we have a range inside of this range, right? Just by following our most recent expansion, our most recent rotation, which was from this low up. So now we have a range right here. However, in order to get from this point towards this point, we need to have some sort of downward structure, don't we? I think we do. So if I zoom in on the 15-minute, what do we see, guys? How should I draw structure on the 15-minute to get from this point to this point? High, low, lower high, lower low, lower high, lower low. Let's put this as our range. Let's get rid of the equilibrium, so we know we're inside of this bigger range. But look at that. In a local downtrend, let's make it blue. We pull a range from bottom to top. And when we have a move back down towards the equilibrium of the range, that's when this range gets confirmed. You see how that works, guys? And then from here, we have a range low, we have a range high, we confirm it on this equilibrium. We get that deviation 1, we get the extreme liquidity grab, confirming a TCT model 2 schematic, have a rotation back up towards the range high of this blue range, okay, right here, exceeding it, coming up towards our main red range high, deviating it from here, and then confirming a model 2 schematic on our red market structure. Now, you don't need to understand the accumulations and the TCT schematics, okay? That will be way clearer in later on in the lecture. But by drawing the right ranges, and for people that have already watched me for a while, you can see how drawing the right ranges allows you to trade the right schematics. So we had our uptrend, okay? We had our uptrend for the higher low, for the higher high right here, confirming our red range, range high, range low. But to get from our range high to our range low, we had blue market structure pointing down, okay? And then both are ranges. So this became our range right here. Let's make that blue. This was our blue range, pulling our structure from top to bottom. This is our red range. Okay, this is our red range. So you had a range within a range, and both ranges had its own schematics. Okay, both ranges had its own schematics, where right here you had a 1 tap, a 2 tap, and a 3 tap at the top. But in order to deviate that high, you had a local 1 tap, 2 tap, 3 tap at the bottom. Okay, which you don't have to understand now, but you can come back to this range timestamp in the video after understanding TCT concepts now and are like, oh yeah, I understand now. But zooming back out again, guys, this red range was simply just from a range rotation back up from this bigger range that we were in. I think I made this also red, but let's call this the black range, right? Let's call this the black range. And that was from our main range, right, where we were trending down on the way higher time frame, like the 4 to 6 hour. Okay. Right here, you can see it, 4 to 6 hour. So we have ranges inside of ranges, and then we check the most recent expansion down on the high time frame from this bigger range. That gave us our 4-hour range, but the same way this 4-hour range can be inside of the 3-day range, we can have 15-minute ranges inside of the 4-hour ranges. So then we were like, okay, what is the main rotation inside of this 4-hour range? Well, we had that move back up right here from this low to that high, creating our red range. But in that red range, we had our blue range. And you know what's so beautiful, guys? You know what's so beautiful? This low right here was our 3rd tap for our black market structure accumulation. So what I'm about to say might sound crazy, okay? But I'm just saying this for the people that have been watching me for a longer period of time. You don't have to understand this as I'm saying it right now, okay? You can come back to this part after having finished the TCT schematic section, and then you'll understand. But what you can say right here is that you had a blue TCT Model 2 schematic, where the purpose of that schematic was to tap the range high so that it could go over into a Model 2 TCT distribution schematic. And that purpose of that Model 2 distribution schematic was to come back down to fulfill the bigger accumulation. Because the high time frame points are always the most important. The same way your high time frame market structure pool is more important than your low time frame market structure pool, the same way your high time frame range is more important than your low time frame ranges. So this 1 and this 2 on the 4-hour, that range low and the deviation, that's the most important, okay? Yes, you may have a distribution here, but you have a bigger accumulation going on. So the same way that your high time frame market structure is more important than your low time frame market structure, the same way your high time frame ranges are more important than your low time frame ranges. But do you guys see with this picture, you can screenshot it, do you see what I mean with ranges within ranges within ranges? Because just on this picture, you can see that we have a black range inside, and in the black range we have a red range, and in the red range we have a blue range. But this entire range is inside of this massive range, right? Basically, when you're charting any asset that is not like an all-time high territorium, you'll always have ranges and ranges. It just depends on the time frame that we're on. But I like to scalp, so I'll be on the 5-minute, and then I'll be trading those blue ranges, and then trading the red ranges that go over in the black ranges. That's what I do, okay? I'm not really a swing trader. So the last thing I want to talk about with you guys is good and bad ranges. Okay, good and bad ranges. It's actually pretty funny because as I'm recording this, like a week ago, I had a discussion with some people I'm teaching about good and bad ranges. Okay, good and bad ranges and what's the difference. Well, I've given you guys rules. Okay, I've given you guys rules regarding ranges. Meaning we have that low, we have that high, we have that move back down, confirming the range. But I want you guys to be rational. I want you guys to be rational. A range is when prices go sideways. A range is when prices are going sideways. Yes, you have your range low, you have your range high, you have the move back down, confirming the range. But if price is trending down very aggressively, just, picture this being a very aggressive downtrend. Okay. Yes, this may be a range, but it looks like it's like very V-shapery, like very sharp moves down. Does this look like prices are going horizontally? No, right? It looks like prices are trending down. And we also know that an SFP can be temporary, and that we can come back down towards that SFP if we break structure, instead of having the full rotation back up. So I want you guys to be rational while drawing your ranges and just look at moments in time where prices are literally just going sideways. You can just look at the chart and you immediately see, oh, we're going sideways here. This must be some sort of range. And then you try to draw structure that allows your range to be valid. Because ranges that are more V-shaped looking are oftentimes market structure pools. When the V gets very extended and very wide, that's when you can expect more of a range. It's literally just horizontal price action. So what I have in front of me right here is scenario 1 and then scenario 2. Okay, just different types of examples. And scenario 1 is that I was talking about with that friend I'm teaching. And just picture this being a very aggressive downtrend, okay? But we wigged the low. So technically speaking, this is a range with a deviation 1. But this is the 4 to 6 hour time frame. So it's a high time frame aggressive downtrend, okay? This wick on the lower time frame consists of a local uptrend on the 10-minute right here. And the 10-minute looks something like this in red. So we have a very aggressive downtrend on the 4 to 6 hour. We wigged the low. So technically speaking, this is a range that you can look at, okay? Doesn't look the best because it's a very V-shapery, very sharp moves. But technically speaking, it could be valid, right? It is valid, technically speaking. But I want you guys to be rational. And then when we zoom in this wick on the lower time frame, we can see a local uptrend on the 10-minute that looks like this. And in a local uptrend, we pull our range from top to bottom. And we can see that was a wick. It didn't exceed it. And then we have a range like this. Oh. And then we have a range that looks like that. I don't know why the color is not changing, but maybe there's some sort of delay. However, where do you think I'm putting more importance on? Okay, what do you think I'm watching more closely? This very ugly looking range that looks like a V shape with a wick, or this 10-minute range that looks like an amazing 10-minute range with amazing deviations for potential TCT concepts? Obviously, I'm paying more close attention towards the 10-minute range because that looks way better from a range perspective. And I have the perfect example right above it. That's why I had it ready, guys. So right here on the higher time frame, let's use that replay mode. Okay, right here on the higher time frame, we were trending down. So you can see the downtrend, okay? You can see the downtrend in our black market structure drawing, okay? You can see that aggressive downtrend. Now, also using our DL tool, you can see that it was a wick, right? It was a wick. So technically speaking, this black market structure drawing is a valid range. But in this move up from our range low deviation, from the low up in this deviation on the 30, for example, we have an uptrend, right? Pictured in red. High, higher low, higher high. Right here. red, highlight it. Okay? What looks cleaner? This V-shaped move down, or this sideways price action, right? What looks cleaner? Technically speaking, guys, this is a valid range. And my friend was watching this black range, extending it to the right after the deviation, and then having this as your range. But then once you will see my TCT concepts lecture, you will have no trade in this black range because the starting points weren't the best. This looked very like market structure wise. I was watching my red range right here. I was watching my red range. Because compare it, guys. This actually looks like sideways price action. And also coming back to that V shape, do you see the difference into how this is very sharp, pointing down, low, lower high, lower low, looking like V's, a V and a v, upside down V and a V. Compare that to this. Compare that to this. Look how extended this is. Whenever you have to draw quote unquote market structure and your V is this wide, that's when you have a range, okay? So I was watching the most rational range because both are technically valid. The black is valid, but the red is also valid. But I told you guys to pay more or put more importance on the high time frame pools, right? Because high time frame pools are more important than low time frame pools. But you have to combine it with rationality. If your high time frame looks like this, you do not look at that from a market or from a range perspective. You just look at it red from a range perspective. Because if you had red on your chart, you have this as your range high. This will be your deviation, not exceeding that limit of the DL2. Amazing. Retest, TCT, Model 2 distribution, and you had an amazing trade. Amazing trade. Okay? And the same goes for this. The same goes for the scenario where, let's say we're trending down, okay? Let's say we're trending down. We have our range low, we have our range high, we come back to the equilibrium. But we have a perfect touch. Like we have a perfect touch of the equilibrium and we immediately go higher. Where do you think I'm paying more attention to? This black range, which technically speaking is a valid range. Let's make it red or black. Or am I paying more attention to the market structure from the low up that has a higher low and a higher high right here? Let's picture that red. And then I'm paying more attention to this range. Right? To this range. Obviously, I'm paying more attention to the red range. And then what could happen is that this red range could break down. And from there, we could start deviating the range low, right? Could start deviating the range low. And now we actually have a bigger range. Like this. Okay? Where this is that first deviation. And that's also a way how, your low time frame ranges right here can go over into bigger ranges by breaking down. Like this low time frame range breaks down, sweeps that black low, and now by having more price action and more time, this actually also looks like a clean range. And we can use this range, right? This range. So, sorry, I got some messages. But, yeah. That's it for ranges, guys. So to summarize it, right? To summarize it, we had... Let's go back to the introduction, okay? To summarize it. We have the theory behind a range, that a range is simply when price is moving sideways. And then it's to restore the balance and the ratio between buyers and sellers. Then when we're trending up, we pull our range from top to bottom. When we're trending down, we pull our range from bottom to top. A range is valid on that certain time frame if the 6 candle rule applies on that time frame. You always want to check the highest time frame that your range is valid on for the deviations. We can have wick deviations or candle close deviations, and we can use the deviation threshold tool to determine if it's a range break or range deviation. Regarding the DL2, we have to extend it after a deviation and coming back inside to the deviation high and then use it again. And when we have the DL2 overlapping with supply and demand, we picture just the DL2 being just above that supply or just below that demand. And the lower the time frame my ranges are, the more strict I am with my deviations. And we want to always watch those highest time frame that our range is valid on in order to see, is this actually a deviation or is it a range break? Because it may look like a deviation or a break on the 30, but it could be a deviation on the 4 hour. And then we have multiple different pools of market structure, giving us also multiple ranges to look at, as we can see in Solana, where we have our red high time frame ranges inside our black high time frame range, but also a 4 hour range that has a 1 hour range that has a 10-minute range, all inside each other. So we have ranges within ranges, and ranges regarding overlapping market structure that causes ranges within ranges. And when we have a range, the most important market structure to look at is just the most recent rotation. So right here, we're moving up, right? That's why I'm checking this range. And then we're moving up. That's why I'm checking this range. And then from there, from this top, we're moving down. That's why I'm watching my structure from the low. That's how we created that range. Okay? So just watch your most recent rotations within the range to determine which structure is the most important to look at. And then we have a difference between valid ranges but not good-looking ranges, where you have to be rational. Okay? When prices are this V-shapery, that's not good. When it's very extended like this, very extended and wide V, that's when you have a good range. Okay, you just want horizontal price action. And understanding this and understanding the deviations, it will set up the foundation for the TCT schematics. Okay, so that's it for lecture 2 of the TCT mentorship regarding ranges. I'll see you guys in lecture 3, where we will be talking about supply and demand. Peace out.